Priya buys a rental property. Jordan puts the same money into the stock market. 10 years later, they compare notes, and the numbers on paper say one thing, but the real math, once you count everything, says something completely different. Today we're going to run the actual numbers, no hand-waving, no cherry-picking, and find out which one actually makes you richer. Let's keep this fair. Priya and Jordan both have $60,000 saved. They're the same age, same income, same city, same starting point. The only difference is what they do with that money. Priya uses it as a 20% down payment on a $300,000 rental property. She takes a 30-year mortgage at 7% interest, monthly payment around $1,600. She rents it out for $2,100 a month. On paper, that's $500 a month in profit before a single other expense. Jordan takes the same $60,000 and puts it into a total stock market index fund, adds $400 a month automatically, and does absolutely nothing else. No tenants, no repairs, no leverage. For the first year, Priya feels like she made the obviously smarter move. She has a physical asset. She can drive past it. She's collecting rent checks and claiming mortgage interest and depreciation on her taxes, shaving thousands off her tax bill. Jordan checks his brokerage account once a month and sees a number that moved slightly. There's no story to tell at a dinner party. Priya's friends ask about the property constantly. Nobody asks Jordan anything. By year 3, Priya has collected roughly $75,600 in rent. Her mortgage payments total about $57,600. That leaves $18,000 in gross cash flow, which sounds fantastic until you subtract everything else. Property taxes run $3,600 a year. Insurance adds another $1,400. She's replaced a water heater for $1,300 and dealt with 1 month of vacancy that cost her $2,100 in lost rent plus $700 to clean and relist. She manages the property herself to save money, which means phone calls at odd hours and weekend showings. After every real cost, Priya's actual net cash flow over 3 years is somewhere around $3,500, not the $18,000 that looked so good on paper. Jordan, meanwhile, has contributed $60,000 plus $14,400 in monthly deposits, and at a 10% average annual return, his account sits around $91,000. He spent 0 hours managing it. No phone calls, no emergencies, no tenants. But Priya still has one thing Jordan doesn't: leverage. Her $300,000 property has appreciated at roughly 3.5% a year and is now worth about $332,000. Her equity, the gap between what the house is worth and what she owes, has grown to around $70,000. That's real wealth, and a meaningful chunk of it came from the bank's money, not hers. This is the single advantage stock investors can't easily replicate, and it's the reason real estate creates so many millionaires. Leverage cuts both ways, though, and we'll get to that. Here's what almost nobody talks about when they brag about their rental income. Vacancy. The average rental sits empty roughly 1 month a year. That's a full mortgage payment with 0 rent coming in to cover it. Maintenance and repairs typically run 1 to 2% of the property's value annually. So on a $300,000 house, that's $3,000 to $6,000 a year, and it doesn't arrive in neat, predictable installments. Some years, it's a $150 faucet. Other years, it's a $7,000 HVAC system failing in August while your tenant threatens to leave. Capital expenditures are the big one. Roofs last 20 to 25 years, water heaters 10 to 12, furnaces 15 to 20. These are guaranteed future costs, arriving in chunks of $5,000 to $15,000, and if you're not setting money aside every single month for them, you're not investing, you're gambling on timing. Property management, if you hire it out, costs 8 to 10% of monthly rent, gone immediately. If you manage it yourself, you're working an unpaid part-time job. And then there's the risk nobody wants to mention out loud. A tenant who stops paying and knows the eviction process can cost you 3 to 6 months of lost rent plus legal fees, erasing an entire year of profit in one bad tenant. By year 5, Priya is on her 3rd tenant. She's replaced the roof for $9,200, dealt with a plumbing emergency costing $1,600, and had 1 month of vacancy between leases. Her actual cash-on-cash return, the money she pockets relative to what she put in, is running around 3 to 5% after real expenses. Not bad, but nowhere near the 15 to 20% she told people about at first. Jordan is still doing nothing. His portfolio has grown to roughly $148,000 to $162,000 by year 7, including contributions. He didn't pick stocks, didn't time anything, didn't do a single thing except leave it alone. By year 10, Priya's property is worth roughly $355,000 to $370,000. Her remaining mortgage balance is about $198,000, putting her equity at approximately $157,000 to $172,000. Over 10 years, after subtracting every real cost, her total out-of-pocket beyond the original down payment is somewhere between $22,000 and $38,000. Jordan's portfolio, with consistent $400 monthly contributions and roughly 10% average annual return, is sitting at approximately $178,000 to $195,000. He put in $60,000 up front plus $48,000 in contributions, $108,000 total. The rest is pure compound growth, and he spent exactly 0 weekends fixing anything. At year 10, they're surprisingly close. Priya might be slightly ahead thanks to leverage, but she also spent hundreds of hours managing the property, took on nearly $200,000 in debt, and put her entire investment in one asset in one zip code. Jordan diversified across thousands of companies and never lost a night of sleep over a broken water heater. This is where the story starts to genuinely separate. By year 20, Priya's property is worth roughly $480,000 to $530,000. Her mortgage is nearly paid off, putting her equity somewhere between $420,000 and $470,000. After 20 years of maintenance, repairs, turnover, taxes, insurance, and at least one major renovation, her total net profit from cash flow alone might be $45,000 to $85,000 above what she spent. Jordan's portfolio at a 10% average return with $400 monthly contributions has grown from $60,000 to approximately $445,000 to $490,000, with total contributions of $156,000 over 20 years. The other $290,000 plus is pure compounding. No debt, no tenants. Number 2 EM phone calls about a broken pipe. When you compare net worth at year 20, they're in a similar range, somewhere between $420,000 and $530,000 each. But how they got there is completely different. Priya worked for hers. Jordan waited for his. Priya carried stress, concentration risk, and illiquidity. Jordan carried volatility, but also liquidity and freedom. Here's the part that changes the math dramatically. If Jordan increased his monthly contribution by even $200, bringing it to $600, his 20-year portfolio jumps to roughly $600,000 to $650,000. That's because in the stock market, increasing your contribution has a directly multiplied effect through compounding. In real estate, increasing your investment usually means buying an entire second property, taking on another mortgage, and doubling your workload. You can't just add $200 a month to a house. There's a piece nobody puts numbers on when they talk about real estate as an inflation hedge, and it's actually one of the most legitimate arguments in Priya's favor. Her mortgage payment is fixed for 30 years. It does not change, ever, regardless of what inflation does. Her rent, on the other hand, tends to rise with inflation over time, historically averaging somewhere close to 3% a year, sometimes faster in hot markets. That means every year, her income from the property grows, while her single biggest expense stays completely frozen. In year 1, her $2,100 rent barely covers her $1,600 mortgage plus expenses. By year 15, assuming average rent growth, that same unit might be renting for $3,270 a month, while her mortgage payment is still exactly $1,600. That widening gap is real, it's powerful, and it's a mechanism stocks don't offer in the same direct way. Jordan's dividends can grow over time too, but they're not contractually tied to inflation the way rent naturally tends to be, and his portfolio doesn't have a fixed, inflation-immune core expense sitting underneath it the way a mortgage does. But here's the trade-off nobody mentions in the same breath. That fixed mortgage cuts both ways. If interest rates fall dramatically after Priya locks in her 7% rate, she's stuck paying above market rates unless she goes through the cost and hassle of refinancing, which comes with its own closing costs, appraisal fees, and paperwork. Jordan's stock portfolio has no such lock-in. If a better investment opportunity appears tomorrow, he can rebalance in about 30 seconds with no penalty and no fees beyond a few cents of bid-ask spread. Priya's capital is illiquid. If she needs $40,000 for an emergency, she can't sell one bedroom of her rental property. She either takes out a home equity loan, which adds more debt and more monthly payments, or she sells the entire asset, triggers capital gains taxes, pays realtor commissions of 5 to 6%, and loses the property entirely just to access a fraction of its value. Jordan can sell exactly $40,000 worth of his index fund on a Tuesday afternoon and have the cash in his account within 2 business days. Let's put a real number on liquidity because it matters more than most people admit until they actually need cash fast. Say both Priya and Jordan need $40,000 immediately. Jordan sells shares, pays capital gains tax on the growth portion, maybe $4,000 to $6,000 depending on his tax bracket and how long he's held the shares, and nets roughly $34,000 to $36,000 within days. Priya, to raise the same $40,000, either takes a home equity loan at a rate likely higher than her original mortgage, adding a new monthly payment on top of her existing one, or sells the property outright, paying 6% in realtor commissions on a $480,000 sale, roughly $28,800, plus capital gains tax on the appreciation, potentially another $15,000 to $25,000 depending on how the numbers work out, all while losing an asset that was still building equity and cash flow. The stock investor's flexibility in a genuine emergency is not a small detail. It's often the difference between a stressful month and a financial catastrophe. If I only showed you the downsides of real estate, I'd be doing exactly what every stock market influencer does, so let's be fair to stock's real risks too. Volatility is brutal, and it's not theoretical. In 2008, the market dropped roughly 37%. In March 2020, it dropped 34% in a single month. If Jordan had $150,000 in his portfolio and watched it fall to $95,000 in a matter of weeks, that's not a number on a screen. That's gut-wrenching, and the data is clear that most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at the worst possible moment. There's also no cash flow. Unlike a rental property, index funds don't send you a check you can spend every month. Dividends exist, but on a total market fund you're looking at maybe 1.5 to 2% yield, which on $150,000 is around $200 a month, not enough to replace anyone's income. And there's no leverage. Jordan used $60,000 to control $60,000 in assets. Priya used $60,000 to control $300,000. That 5:1 leverage is powerful when property values rise, and it's the main reason real estate produces so many millionaires in surveys of self-made wealth. There's also no depreciation tax shelter in stocks. Real estate investors can deduct the theoretical decline in a building's value from their taxable income, even while the property is actually appreciating in the real world, and that's a legal advantage stock investors simply don't have. So when does real estate actually win, specifically and identifiably? If you're in a market where the rent-to-price ratio is strong, meaning monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one instead of fighting you. If you're willing to treat it as an actual business rather than a side hustle, screening tenants carefully, budgeting seriously for capital expenditures, building real systems, the returns can exceed stocks, especially with leverage working in your favor. If you use house hacking, living in one unit of a multi-unit property while renting out the others, you can reduce your own housing costs close to zero while building equity, something the stock market simply cannot replicate. And if you understand 1,031 exchanges which let you defer capital gains taxes by rolling profits into a new property, you can grow a real estate portfolio tax-deferred in ways stock investors can't match outside of retirement accounts. Real estate isn't a bad investment. It's a misunderstood one, wrapped in survivorship bias from people who bought at the right time in the right market and never mention the years they spent underwater on a bad tenant or a dead roof. Priya and Jordan both walked away from their choices, thinking they'd made the smart play. Priya thought real estate was the proven, tangible path to wealth. Jordan thought the stock market would quietly do the work for him. Neither of them actually sat down and mapped out the full cost in dollars, in time, in stress, and in risk before deciding. Over 10 or 20 years, the real trap isn't real estate, and it isn't stocks. The real trap is picking either one based on a YouTube thumbnail, a podcast clip, or something your cousin said at a barbecue, without ever running the complete numbers for your specific situation, your specific market, and your specific tolerance for a phone call at midnight about a burst pipe. And if you're wondering what happens when you do both, When you own property and invest in the market at the same time, splitting your capital instead of betting it all on one path, that's a completely different conversation, and the math changes in ways that might surprise you. But for now, the next time someone tells you real estate always wins or the stock market always wins, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that actually matters.